Imagine two traders. Both start on the same day, same capital, same motivation, same goal: to make money in the markets. One chooses Forex, the other chooses indices. Fast forward 1 year. One is frustrated, constantly confused by unpredictable moves. The other has found a rhythm, a system that actually makes sense. Now here's the question: was it skill or the market they chose? Because choosing the wrong market doesn't just slow your progress. It can completely change your results. And if you're trying to decide between indices and Forex, this video might save you months or even years of frustration. Understanding the basics first. Before deciding which one is better, you need to understand what you're actually trading. Forex trading is the buying and selling of currencies. You're trading pairs like EUR/USD, GBP/JPY, or USD/PKR. Every trade is based on the relationship between two currencies. Indices trading, on the other hand, involves trading the performance of a group of stocks. For example, the S&P 500 represents the top 500 companies in the United States, while the Nasdaq 100 focuses heavily on tech companies. So right from the start, you're dealing with two completely different types of markets. One is influenced by global currencies and macroeconomics. The other is influenced by company performance, economic growth, and market sentiment. Market behavior. Which one moves better? One of the biggest differences between Forex and indices is how they move. Forex markets are known for being highly liquid, but often slow and choppy. Prices move in small ranges most of the time, especially during normal conditions. This can make it harder for beginners to catch strong trends consistently. Indices, however, tend to move in cleaner, more directional trends. Markets like the S&P 500 or Nasdaq often follow long-term upward movements because economies generally grow over time. This creates a major advantage, because when a market trends clearly, it becomes easier to trade. You don't have to guess as much. You follow the direction. Volatility, opportunity, or risk. Volatility is where things get interesting. Forex markets usually have lower volatility compared to indices. That means price moves are smaller, which can be safer but also slower when it comes to profits. Indices, on the other hand, are more volatile. They move faster and cover more points in a shorter time. This creates bigger opportunities, but also bigger risks. For example, a single move in Nasdaq can be equivalent to multiple Forex trades combined. So if you manage risk properly, indices can offer faster growth. But if you don't, they can wipe out your account just as quickly. Complexity. Which one is easier to understand? Forex is heavily influenced by multiple factors. Interest rates, inflation, geopolitical events, central bank decisions, and economic data all play a role. You're not just analyzing one country, you're analyzing two at the same time. This adds complexity. Indices are simpler in comparison. While they are still affected by economic factors, the overall direction is often tied to growth. Companies grow, economies expand, and indices follow that trend over time. This makes indices easier to understand, especially for beginners. Trading sessions and timing. Forex markets operate 24 hours a day, 5 days a week. This sounds like an advantage, but it can actually become a problem. Because when a market is always open, traders often overtrade. They jump into setups that aren't clear simply because the market is available. Indices have more defined trading sessions. For example, US indices are most active during the New York session. This creates structure. You know when to trade and when to stay out. And that structure can improve discipline. Profit potential. Which one pays more? Let's be real. This is what most people care about. Which market makes more money? The answer depends on how you trade, but generally indices offer higher profit potential in shorter time frames due to their volatility. Forex trades can be profitable, but they often require patience. Moves take time and profits build slowly. Indices, however, can deliver large moves in a single session. This means fewer trades, but bigger impact. For many traders, That's a major advantage. Risk management, the real game changer. No matter which market you choose, risk management is everything. Forex might feel safer because of smaller movements, but overtrading can still destroy accounts. Indices might offer bigger profits, but without proper risk control, losses can be massive. So the real difference isn't just the market, it's how you manage your trades. The best traders don't just focus on making money, they focus on protecting it. Psychology. Which market is less stressful? Trading is not just technical, it's psychological. Forex can be frustrating because of its choppy behavior. You might enter a trade, see it move slightly, then reverse, then move again. This creates emotional stress. Indices are more aggressive but clearer. They either move or they don't. This clarity can actually reduce stress because you're not constantly second-guessing every move. For many traders, this makes indices mentally easier to handle. Which one is better for beginners? For beginners, simplicity matters more than anything else. When you're starting out, you're already trying to understand charts, entries, risk management, and emotions. If the market itself is too complex, it slows down your learning even more. This is where indices often have an advantage. They tend to move in clearer directions, which makes it easier to understand market structure. You start recognizing patterns faster. You begin to see how trends form and how momentum builds. In Forex, because you're dealing with two economies at the same time, things can get confusing. A pair might look bullish, but suddenly reverse because of unexpected news from one country. For a beginner, that can feel random and frustrating. Indices, on the other hand, are often driven by overall market sentiment and long-term growth. This makes them easier to follow and easier to learn from. That doesn't mean indices are easy, but they are more straightforward. And when something is easier to understand, you improve faster. That's why many new traders today are starting with indices instead of Forex. Not because Forex is bad, but because indices give you a clearer learning path in the beginning. Final verdict. Which should you choose? So which is better, indices or Forex? The truth is, there is no one-size-fits-all answer. Both markets have their advantages, and both can be profitable if you know what you're doing. But the real question is not which market is better overall. It's which market is better for you. If you prefer slower movements, more time to think, and a market that doesn't move aggressively, Forex might feel more comfortable. But if you prefer clear trends, faster moves, and opportunities that don't require constant waiting, indices can be a better fit. Another important factor is your personality. Some traders perform better in fast environments. Others need slower pace to stay disciplined. If you choose a market that doesn't match your personality, you'll struggle, even if your strategy is good. So instead of chasing what's popular, focus on what suits your mindset. Because in trading, alignment matters more than hype. And if this helped you understand the difference clearly, make sure to like this video and subscribe for more content like this. Because the goal isn't just to trade, it's to actually become profitable.